Hey guys, welcome back to the channel. My name's Max. My channel's name is The Covered Collar. Now here at The Covered Collar, I specialize in covering the high yield option-based income funds, and especially the option-based funds, but not always. Tonight we're going to one of the two funds we're going to cover is actually not option-based. Now both of these funds are based on MLPs, Master Limited Partnerships. And I know a lot of guys in my Discord like MLPs, and I know that we follow some closed-end funds that invest in MLPs, but also ETFs that do as well. Anyway, we have two brand new funds to look at that invest in MLPs. We're gonna look at them tonight. Now, one of them is called T, as in Tom, or as in Tortoise, Tmlp, and it's from Tortoise Capital. One's called Mlpi. Now that's from Neos. On the surface, these two funds look like they're selling the same, vision, which is tax efficient exposure to energy infrastructure, pipelines and stuff. That's what MLPs do generally, without the dreaded K1 form. So neither of these ETFs give you, you don't have to file taxes as a partnership, which I believe that's the K1's the partner form or something like that. Just adds an extra layer of complexity. Now that you don't have to do that, like you do on some other pipeline limited partnership type deals, you just get the same form you would get with any ETF. You get it on a 1099. You file taxes just like you would if you had the SPY or you had the Qs or you had Alti or whatever you had. It would be the same type of tax burden. So that's good. That's what these two have in common. But beyond that, they have a difference. One's going to be a pure play index tracker, basically using swaps. The other is a high octane income accelerator, and it's using options. Now, today we're going to break down the math, the mechanics, risk reward, the trade-offs, just so you know exactly what you're looking at, what we're looking at, what you're invested in. All right, stick around. We'll get right in the middle of it. All right, who is Tortoise Capital? Now, first we need to talk about who's running the show down there. Most of you know Neos. They've become kind of a household name in the covered call space over the last few years. But there's a new player here, Tortoise Capital. Now, it might be new to some of you guys, but not in the MLP world. Tortoise has been around since 2002. They're out of the Kansas City area, the Overland Park area, a very nice area. They manage about $9 billion in assets. Get this, they launched their first MLP. Now, it was a closed-end fund, but they launched this thing way back in 2004. That's right, 2004. The name of this closed-end fund is TYG. Now, like I said, it's been around since 2004. These guys also own and author an MLP index. And of course, their index, which is the Tortoise MLP index, which is the exact index that the Tmlp fund tracks. They're just tracking that index. So these guys aren't some startup trying to slap a new label and, on an old strategy. These guys have been in the trenches and, so I thought that was good to know. Now, it's also good to realize they have 6 other ETFs. Like I say, I haven't said it yet, but I have a special PDF report on their other funds, and you can go download it at my Patreon. But right here's a chart of their other ETFs. Now, one of them that you notice that I was also interested in is called TNUK, TNUK. It just came out recently, and it looks pretty interesting. It's, playing the renuclearification of America play, and I know that's a hot area right now. I'll be anxious to see how that one does. Okay, so let's talk about Tmlp, the Tortoise one. This is the pure play. So this is how these guys make money. They use swaps. They don't use options. So one of the other things, the swap is based on their own index. So they make an index, and then they go get a counterparty, or usually a bank or something, to take the other side of the trade. And so they're invested in their own index, which is a MLP index. Now, that they also use a structure called a RIC, which is a registered investment company. You hear Mike Coe talk about RICs all the time. He's always talking about the RIC rules and stuff. But I think the long and short of it is, registered investment companies have different tax and reporting mechanisms, and for some structures and strategies, they can be favorable. And this one evidently is one of those, or at least that's what the guys from Tortoise thinks. So here's the thing, though. So they structure it as a RIC, and they don't actually own the limited partnerships directly. Instead, they just use the total return swaps based on not even the limited partnerships, based on an index, and the index is based on the limited partnerships. I know it's complicated. It took me a while to figure it out. So the fund also holds cash and, of course, collateral to leverage, or not leverage, to collateralize their swap, their agreements with the banks. Now the bank is going to pay the fund the total return of the index. That's price appreciation plus distributions. And the fund's going to also pay, but the fund is going to have to pay a small financing fee, of course, right? Because the bank is like the bookie or the broker. The bank's facilitating the trade. So they're going to get a fee, but basically the bank is going to give the fund the money, going to give the fund money if MLPs make money, and the NAV goes up, and and the reverse would happen if the NAV goes down. I think then the fund would end up owing the bank money. All right. So why do they do this? What do they do all this stuff? And I think the answer is the registered investment, the RIC structure, cuts off a corporate tax that ETFs have. It gets around that. So they're getting around, I think it's 21% tax that usually hits MLP ETFs. So the yield you get, but at the same time, they aren't selling options or anything. So the yield you get from this Tmlp should be about what the index yields, which is around 5 to 7%. In other words, it's what the pipelines pay. It'd be the dividend if it was a stock, but anyway. And so that's 5 to 7%. So this thing, I would expect, maybe based on that, and this is from the company itself, based on that, I would expect maybe 0.5% a month. And then plus you're going to have upside and downside exposure to the price, to the index in general. If, depending on, MLPs are priced on different factors: the price of oil, the price of interest rates, the price of oil, and numerous other factors. And so, of course, the price, the NAV of the MLP themselves, and thus the index, will go up and down. But the idea is you should get 5 to 7% minus financing cost, right? All right, so this is efficient, and but you aren't getting any extra juice from the options. Okay, you just get what the MLP makes. All right. Now, what this kind of reminds me of, and people in the high yield space will be familiar with this, kind of reminds me of a round hill strategy. Think about a round hill fund. Let's just say TSLW. TSLW gives you, they use total return swaps on Tesla, and they don't use options, right? And the bank, and if Tesla goes up, the bank pays them money, and they use that money to pay the TSLW yield. And if the opposite happens, the opposite. But it's very, I think this is somewhat similar to the round hill method. Now, round hill and those W funds is also using a little bit of leverage, but not including the leverage. I think that this TMLP is like going to be the round hill of MLPs. I don't know. All right. So now let's look at the competing fund. So the other one is called Mlpi. Now, this is from Neos. Now, this launched December 18th, so just a few days before TMLP did. Now, it has a slightly higher expense ratio. I think TMLP was 0.5%. Or I'm sorry, or no, I'm sorry, TMLP was 0.5%. Mlpi is 0.68, unfortunately. But at the same time, MLPI has already paid 2 dividend payments, and it looks like it's yielding about 15% at this point. So it looks like about triple the yield. Now, but it does have a little extra expense ratio. So how are these guys paying triple the yield? How are they doing that? And the answer is they are physically buying the stocks, the companies. And now they're using a different index, but it's another MLP index. It's called the Mercube North American MLP and Energy Infrastructure Index. All right, so they let's look at their top 10 holdings. So these guys actually own stock in these companies and more, but they have a portfolio of stock. Now, the people that choose the stock the stock is chosen by the Mercube index. So, but they buy the stocks in that index. Now, the Mercube index doesn't have a yield on it. So they buy the stocks in that index, and then they take it upon themselves to write options on it. Okay, now this is Neos, and so we've seen Neos in action before. They're kind of their if it's going to be anything like SPY, or anything like Triple QI, I'm sure it should be. I would imagine these guys will catch a decent amount of upside and will do a great job. Now, of course, this thing is still going to track the energy business. If the energy business goes straight down, the pipeline business, the value of that business goes down, global recession or whatever, that's, this fund's not going to do great. It's dependent on that. But I'm saying as long as that business does great, this thing should be, I would imagine, I'm picturing a SPY type thing. It's going to yield around the same 15, SPY yields 12, Triple QI yields 14. So we'll see. We'll see. Now, you guys remember when you write options, of course, you do, and these guys are using flex options, but you give up. You can have the effect of capping some of your upside. So it's not free money. It comes at a cost. But also these funds in here, lots of these funds, or I think all of them, pay really good dividends too. So they're getting money from the dividends of these funds. Say the average portfolio dividends 5%, and then say they're earning 10% from selling options, and they're paying you guys 15%. Like I say, you're still exposed to the market going up and down, but the income component of it looks pretty good to me. And I would be more interested in the Neo strategy than the Tortoise strategy. Nothing against Tortoise. I've never heard of them before. Nothing wrong with that. But I just like the idea of option premium. However, to be fair, in a runaway bull market, Tortoise will probably do better because they aren't selling options. So, maybe for a younger guy looking more for growth, Tortoise, maybe an older guy, the Neos one, maybe somebody looking for a little more yield, the Neos one might work a little better. But Tortoise pays a decent yield too. 5% is not nothing. 5-6%. I mean, could definitely help in retirement. It could help with retirement planning. It could be a piece. It could be a piece in the puzzle. But essentially, Neos is kind of double dipping. They're selling options, and then they're also getting regular dividends. That's probably why they're selling flex options also. So because a flex option can't be exercised early, or you can specify that it can't be, and so because they don't want to get they would avoid having these stocks called away from them, because they want to make the dividend and sell premium, so they can use a flex option and they can alleviate that problem. All right, so lately the distributions have been 100% ROC, which has the effect of deferring taxes, and a lot of people like that. All right, so let's talk. So TMLP another thing about TMLP, it pays quarterly, and it goes more for total return. MLPI pays monthly, and it goes more for income, right? We understand that. So with TMLP, Tortoise product, the big risk is counterparty risk because they're using swaps. The return depend on the banks on the other side of the trade. If the bank defaults, rare, but it happened in 2008. It's not impossible. If that happens, the fund would have a problem. And then, of course, you also have financing risk related to interest rates, and because you have other things to think about, but the main one is counterparty risk. Now, with the NEOS method, the MLPI, the risk is the upside cap, right? Because they're selling options. Now, and like I say, NEOS has a pretty good reputation of not capping their upside any harder than they need to, but still, it does happen. It does absolutely happen. So when the energy sector is ripping higher, you could be having an opportunity loss, and usually are. So just have that in mind. You might be better off just getting the underlying companies yourself if you don't have the income. When you're doing the NEOS method, you're trading potential future growth, so for guaranteed cash flow today, but 15% yield isn't bad. Now remember that yield's going to go up and down too. It depends on the volatility of the market and the underlying stocks, right? If the market gets super quiet, option premiums will shrink and the yield could go down, right? All right. So the bottom line is neither fund's really better. I'm saying they're just different. So think of, the Tortoise product. TMLP is just an index tracker. It's for total return investors who want exposure to that part of the economy, natural resources, pipelines. Heck yeah, that's one to maybe look at, especially if you don't want the complexity of the K1 and the partnership tax liabilities and stuff, which no one wants. So I mean, these are layups as far as putting them in 1099s. I don't know anyone who wants a K1. All right, but now let's think of the MLPI as the income maximizer. It's going to be the income first. It's going to be for income first investors who are willing to take chances on capping upside. All right, so I'm going to be watching both of these, and I'm going to put them in my own proprietary metric, the max factor. Now they have to be about 3 months old before they start showing up in the rankings, but we will absolutely start looking at them. I'm obsessed with these high yield funds, and all of these funds do the same thing. They have, or you can measure the same thing. It doesn't matter if it's a covered call fund or a limited partnership. You can measure some metrics, and it can show you what kind of risk you're taking and reward you're getting. And I think the max factor does that very good, and I have nightly shows on it. So tune in for those shows. All right, guys. Well, go read the rest of this on my Patreon. Like I say, I'll upload that PDF special report on their other funds. Maybe you guys might want to look at that. And I appreciate you guys for being here. Remember, not financial advice. Consult your own financial planner. And if you'd like to support the station, you can do that at paypal.me/Max Convexity. And I would also like to remind you to like and subscribe.